Hey everyone, Michael Rosmer here with Richucation. Welcome back. We're here today to talk about the third rule of investing. There's 5 rules of investing to maximize your risk-weighted returns. It took a lot to boil these down to 5 key points, but this one today we're talking about is really the foundation of Warren Buffett's investment principles. Okay, and so that's rule number 3. By the way, so the whole point here is to maximize our risk-weighted rate of return. Okay, so we're not always going to get the best rate of return. There will be somebody else out there who will do better than us. Forget about that. Don't worry about it. That's not the point. The question is, after you account for risk, did you get the best rate of return you could? Or at least, improve your risk-weighted rate of return. Because risk is what it destroys them. They'll be like, oh yeah, the 25% rate of return. No, it's listed as a 25% rate of return. And after you account for risk, it's a negative 10%. So it's a bad investment. Okay? So rule number 3, you could screw up doing this. Okay? So this is like the foundation. The majority of people that I know of who consistently beat the market apply this principle. All right? It's at the foundation. But whereas the previous rule, one about buying things that are going to go up in value, you can eventually hold and deal with. If you don't apply that with this one, if you just apply this one, you could still lose money. Fair enough? So it is buy for less than it's worth with a margin of safety. Buy for less than it's worth with margin of safety. Okay. So we're going to talk about 2 things here. First of all, we had talked before about value, and we're also going to talk about margin of safety. Okay, so price versus value. What something is worth is the value. What you pay for it is the price. Okay, so now it's hard to figure out what something's really worth. All right, so I'll give you a few examples of ways that you might figure it out loosely. Let's say that we were talking about a house, okay? So say we're talking about buying a house, I might look at the construction costs or the replacement costs. If I'm talking about buying a business, I might look at what would it cost me to recreate the assets in that business. Is that the definitive way to value? No, absolutely not. I'm just giving you some ways. And again, when we go back to rule number 1, valuation is super sophisticated and super challenging. We're going to spend a lot of time in it in subsequent videos, okay? But the point is, the price, what you pay for something, is not what it is worth necessarily. It might be, but if you don't know that difference, you're shooting yourself in the foot. Now, why is this rule so important? Okay, we talked about why the previous one was. Let's imagine that there is a house, and the house is worth, I don't know, $500,000. Okay, so $500K. Now, that house could go up or down in value, right? That's what happens to prices. They go up and down. Hopefully over the long term they're going up, but if it's, say, currency, it could be going down. Now, if I bought that same house for $400,000, is my chances of losing money higher or lower than if I bought for $500,000? Lower, of course, because the chances now for me to lose money, it has to drop $100,000 and I'm still at break even. So it has to go down more than $100,000. Versus if I paid $500,000, then as soon as it drops $1, I'm down. Okay? I've lost money. Or if I crystallized that loss, if I sold, right? On top of that, if I buy for $400,000 instead of $500,000, what is my upside? Higher or lower than if I paid $500,000? Higher. Because I automatically have this built-in differential. I can literally add to my net worth the day that I buy it. Fantastic. Amazing. So that's the basic principle is, all right, find something. Now, here's the point, okay? Do you know it's worth $500,000? How do you know that? You don't. You might know approximately, all right? Now, how approximate it is depends on how knowledgeable you are and what the market is and how much data you have and the asset class and all this kind of stuff, right? So that's why we have margin of safety. So what is margin of safety? Margin of safety is, let's say that it's, again, we've done the analysis, maybe we're talking about a house, we've done a CMA, a comparable market analysis, we've done an appraisal, Maybe we've looked based on cash flow, cap rates, so that's the amount of rental income relative to the purchase price. And based on those things, we say, okay, it's worth $500,000. But might we be wrong? Yes, we might be. So, because we might be wrong, it's not, let's say that we say, okay, well, we think it's worth $500,000. But how much could we be wrong? Well, it could be 10% off, let's say. And 10% on real estate is fairly reasonable. On stocks, it's you usually want to go further, but it depends on the type of stock, etc. So what that means is it really could be worth $450,000, which means if I pay $450,000, there's a chance I'm buying it for what it's worth. I'm not actually buying it for less than what it's worth. So what I want to do is any time that I'm buying, I want to say, okay, here's what I believe the value is. Then I want to say, okay, here's a margin of safety, so it could be worth less, and then I want to go a margin below that, okay? Which means I'm ideally targeting, in most cases, depending on the asset class, 20 to 50% below the market value, or below the seeming value. And sometimes you can do that, sometimes you can't. Again, it depends on asset classes. And some markets are more efficient than others. Sometimes you might have to go way further down them. Sometimes you're like, wow, I'm so uncertain here that it could be half of what it is that I think, in which case you need to go much, much further down. So that's the concept of margin of safety, right? So you've got, here's the value, here is your margin of safety, okay? Which, by the way, could be the other way as well. Like, right, you might think it's worth $500,000, it might be worth $550,000, okay? And you want to go below that value, okay? And ideally, you're going to go a lot below it, but that depends. So, point is, figure out what it's worth, then take a buffer. Whatever you think your buffer is, make it bigger. That's especially in business, especially in things that are the values fluctuate a lot, the values are harder to hit, they're things like this, and then go below that. Okay, it's a fairly simple concept, but doing it in practice, like figuring out, okay, how do I know what it's worth? How do I know what a fair margin of safety is, and how much farther to go? That can be challenging. So that's what we're going to go into more detail on the subsequent videos, and I hope you'll join us for those. We'll see you on the next one.